sleep early, but it backfires.
I see.
How about you? Why did you wake up so early? Is that habit or?
I don't know. Maybe there are too many things in my mind. Your examination and my recruitment, my business. I did last night. Did my video. I did a video last night, just before sleep. So, have you seen it?
No, I just seen the notification.
Yeah, that there's. It was posted. It was posted in LinkedIn, and my brain runs too fast, and then sometimes just couldn't sleep. This one. Jeez. I did a bilingual one. Are you protected against COVID-19 as a video in Chinese and in English?
Wow.
So fortunate for you. Okay, today we're going to start Zoom and then record it for future reference. And then I'm going to go over paper 1 and paper 3 with you when Soumya will be joining us in half an hour.
How about Naveen?
Oh, no, Naveen won't join us. Wednesday morning is just for you and Soumya.
Okay. Is he still in morning, Naveen?
I think he said he finished yesterday. Yeah, it's a 7-day. Yeah. So, do you have breakfast?
Yeah. Before hours.
It's recorded. Say something first. You say something. Hello, good morning. This is Augustine Chow, and this is Rianita. We are here to start another session, review session for paper 1 and paper 3. And I recorded it so that the others can, yes, you won't be able to show your face. Yes, here. Yes. Hey. You can take off your mask if you want to. And then I think this recording will be used, made open to any candidates who is taking this exam, and hope it will help. And the purpose of this meeting is to go about the paper 1, principle of insurance, and paper 3, long-term insurance business, and to explain some of the details so that it will be easier for you to study and to read at your own time. Okay, here we are now. We are on principles and practice of insurance because all of you might have read the syllabus, so I don't repeat the full content, but I'll just highlight some of the points that I think that will go beyond the self-study. First thing about the examination. If you're taking paper 1, so this is the weight distribution of the question paper. Paper 1, I think they have 75 questions. Yeah. 75 questions. And then 30% of the question will be coming out from the section of principle of insurance. So the red color ones are the ones that you need to really pay attention to. Don't forget, there's a 20% of the question coming from the regulated framework, and which keep being updated from time to time. And recently, the Insurance Authority has issued a few guidelines, new guidelines, Guideline 21, Guideline 23, about the ethical standards of insurance agents. I think this is part right now has not been updated in your syllabus. You need to spend time reading the guidelines and get yourself up. Correctly. 1/5 of questions are from this regulated frameworks. How much fine, how much imprisonment you'll get if you violate data protection law or the money laundering law, etc. and etc. This is an easy part. It's just some testing your memory. So you need to spend time reading it and memorizing some of the memory of the fines and imprisonments and the out. Then this will be easy. And 7% will be on ethical issues. So if you reach the latest ethical standards, the 8 principles, you will be able to pass all the questions in this section. So it's easy to pick 7% and pick up this 21%, and you are 30% okay. And you are, if you are, you know about the, oh, this part is, it's also easy. The 9% core of the insurance company, some basic common sense. What does the human resources department do? What does an actuary department? Something like this, very simple. If you read the syllabus, you'll be able to get this 9%, this 30% score. And then if you miss something in the risk management and principal insurance, you'll be okay. All right. So paper 1 is not so difficult if you understand the principles. So we strictly go to the principles. So in the examination, you will see a lot of questions arising from risk. What is risk? Risk is such uncertainty. Uncertainty that leads to potential loss. And this is easy. I won't repeat it. Financial risk, measurable physical risk, measurable emotional risk, is never insurable.
Yes, it's going to be quantified, right?
Cannot. Yeah, it can be quantified. Emotional, you can quantify it in a scale, how sad you are, how depressed you are. You can quantify it, but you can compensate it. You know, there's no monetary values assigned to the emotional measurement. You know, the physical, you can assess people's death of the person by this lifelong values. They can assess the personal injury cost by how much they spend in the hospital. Financial loss is easy. If you make a loss in the business, how much do you lose? If there is a fire that costs you to shut down your shop, and then it will cost you a lot in your revenue, and how much, like COVID right now, this COVID, government try to assess the COVID financial impact to the industry, and then develop a recovery plan. But unfortunately, there is no contract, no insurance contracts for the commercial losses arising from the COVID. No such policy. So although it's measurable, it's financial, but it's not, measurable in terms of the COVID risk. So I think you just need to remember this term, peril, just cause of the loss. It's just a technical term, peril. Okay. And cause of the loss. Happen to a property, something, a dead body, something that a thing or a person. Can be goods, can be anything, or a person. And then this is important chart. You must remember these 2 words, insurable. Only financial results of pure risk are insurable, and particular risks are insurable. What is pure risk?
Risk that no one could predict. It's purely risk.
Yeah, everything can be predicted. The pure risk is you can identify the cause and identify the losses arising from this cause. There's a direct relationship with the cause of the loss and the financial loss. That's called pure risk.
That's particular risk.
Particular, yes, particular.
Because you can identify the cause and it just affects one individual, not like fundamental who affects all of people.
Well, particular risk is related to cause and effect. Particular risk of a cause, like a fire. Fire is a particular risk. Flooding is a particular risk. Nightling is a particular risk. Or in marine cargo insurance, the loss of cargo due to the actual problem is a particular risk. This is caused by some reasons. But pure risk is related to the nature of the risk.
So, for example, like accident?
Accident, medical risk, going to the hospital, getting cancer. Or let's say 5 out of 100,000 people. That is a pure risk.
I see. Okay.
Okay, so we have to find out. And speculative risk is not insurable because you cannot compensate people with speculation. And fundamental risk is not insurable too because it affects too many persons in one time. I think they always have this questions of risk management. This is a technical term. In insurance, we are part of the insurance management, but we are not the only risk management tool because there are other risk management tools. For risk management, they often ask you to have to quantify them, identify them, quantify them, and deal with them. And they have different ways of dealing with risks. I think it appears on the other chart. It's just one of the tools. It's not the only tool. And insurance is particularly a transfer of risk. There's a transferor and a transferee, and right. And who is the transferor? Who's the transferee?
Transferor
in the insurance, in terms of the insurance.
Transferor is the company, the insurance company. Transferee is the person.
No, the transferor is the policy holder. I transfer my risk. I transfer my death risk to the insurance company. The insurance company take over my risk.
So they are
the transferee. They are receiving end of the risk.
Okay.
And what happened to insurance company? If insurance take all the risk from different person, from what did they do with risk? They just accept the risk?
No.
What did they do?
They assess it, avoid it, and then therefore principles.
Well, how can the insurance company avoid risk? They just take the risk carrier. They take over all the risks.
They decide which risk they want to take in underwriting.
Well, that's underwriting part. They can underwrite and they have to avoid some of the risks. I don't want to take this risk, but they concentrate all the death risks, all the death rates of 3 million people, like AIA, with 3 million policyholder, and all the 3 million people death are concentrated in AIA. What will AIA do to protect himself, to manage the AIA risk?
They also have risk management by making investment, and then
investment doesn't help. Investment is how you can make use of the money to make it grow so that you have money to pay. That is that is the investment risk, but not the financial, the death risk. We are taking the death risk of the other persons. Can an insurance company buy insurance?
I think yes.
Transfer the insurance company risk to other insurance company?
I think they should be, because insurance company is also an LTD, right? So they should be able to buy insurance.
There is a business called reinsurance. Reinsurance. It means an insurance company can segregate a segment of the risk, a certain age, certain limit, and then transfer the risk, pay the premium, and transfer the risk to another insurance company. And the insurance company at that end is called a reinsurance. So insurance and reinsurance. There is a market, insurance market, buying and selling of the risk.
Then the reinsurance is just transferring it to another company.
Yeah, it's correct. Like I want to buy insurance for my rocket, right? Or the satellite. It costs several hundred millions to send a satellite in the sky. So one insurance company cannot take all the risk. Well, if it collapses, if it blows up, so the insurance company will form a consortium of insurance companies, and the risk will be spread out to other insurance companies around the world. So that is how we manage the risks of the insurance company. We call it reinsurance. So these stupid questions sometimes come up. What's the primary and auxiliary function of insurance? The primary function is only one: transfer risk. Risk management too, one of the risk management too. And the other risk management too is to avoid it, to save it, to minimize it. So there are 4 risk management tools. So an insurance is just part of it. And what's the nature of insurance? What kind of risk will we put under insurance? We say that it's related to pure risk, related to specific risk, and there is 2 particular characteristics of insurable risks.
Financial and physical?
Yes, but it also means the chances of this risk is small, but the consequences of losses is high. Only this type of situations we will need an insurance, right? I cannot buy the insurance for breaking my fingers because it's too small. Financial loss is too small, so no one will be interested in taking my risks. I cannot transfer my risk of my shoes. Getting a new shoes because wear and tear. It will wear and tear. It's a risk that I have to accept. I have to accept it, right? So there's some risks that a person has to accept, not transfer. But insurance only happens when it is dealing with pure risk, particular risk, when the consequence of the risk is high and the occurrence of the risk is small. Chances are small, and the outcome is high. So these are insurable business.
How about if what they want to insure is their livelihood? For example, like singer, they sometimes insure their voice cords. Can that be done?
This is called a property, the property of a person, and it's normally not life insurance. It's we call it general insurance. Part of the general insurance, like you can like an asset, a personal asset, it's like an art, like your natural resources is a voice, or people who are singers who have the figure, the body, the face. Well, some insurance company can accept that. They'll charge a premium. This is a very particular risk.
Right. I see. Okay.
Oh, primary risk and ancillary risk. And these are ancillary because insurance will create employment, but it's not the purpose of insurance. It can help people save, invest money, prevent loss, even prevent loss, and loss reduction is ancillary function. Financial services like a mortgage, is also an auxiliary function, although insurance is one of the financial services. And there are three types of financial services in the community. For example, banking is one. And banking, there are many branches of banking: investment banking, private banking, commercial banking, import-export banking, trade finance banking. There are many types of banking. And security is another one. Security business, where you have the brokers of securities for public listing, for buy and sell stocks, and even derivatives, warrants, options, that kind of thing. And then there's financial services. Insurance is the third pillars of the financial services. Whose business just to concentrate the risk, spread the risk, and then make a profit out of this risk management. So economic growth is one of it, because insurance company help the stability of the economy. Concentrate, accept all the community risk, and then spread it over. So it helps economic development, provide a stable development path for the industries, for the people working in the industries to grow. These are ancillary functions. Okay.
Okay.
Okay, let's skip this and go to when we go to the mock-up questions. Okay, legal principles, and this is very important. An insurance contract is a contract, and I think insurance business is governed by several laws. Contract law is one thing, contract law, agency law, and the insurance ordinance, which is the law governing the setup of insurance company, management of the insurance company, and qualification of insurance intermediate. Something like this is called the Section 41 of the Hong Kong law. Authority. Insurance. It's called insurance. The ordinance, insurance ordinance. So three basic laws governing the insurance business. So the basic principle of the contract is that you must have two parties, right? Two equally legal rights enforceable party. The contract is going to be enforceable, meaning that it's enforceable in a court, in a jurisdiction. A insurance contract signed outside Hong Kong may not be enforced in Hong Kong. Okay. So if there is a person in Hong Kong who buys an insurance policy from an American company, and the contract is governed by American law, it cannot be enforced in Hong Kong.
So they buy insurance for Hong Kong or for US?
Yeah, overseas companies where they do not have the jurisdiction restriction, they can sell insurance companies to Hong Kong residents. Oh, I can buy the American policy, I can buy UK policy.
Okay.
But I cannot enforce it in Hong Kong. I cannot sue the
I
insurance company overseas in Hong Kong because the contract is not signed. It's not governed by Hong Kong law.
How about if the person comes to Hong Kong and then sues the company?
No, Hong Kong does not have any jurisdiction over the laws outside Hong Kong. A foreign contract and governed by foreign laws cannot be enforced in Hong Kong.
So they have to battle it in the court.
You have to file the lawsuit in the court of the contract where they have the jurisdiction.
Okay.
Like the U.S. sanctions, that's nothing to do with Hong Kong. It's not enforced. U.S. sanction in Hong Kong. It's only enforced by the American companies because they are bound by American laws, but not by local citizens.
Okay.
And the contract must not be signed for legal consequences. Serious thing. If it's a law, a contract does not have to be written form. I can offer you lunch, and you accepted it, and it's a contract. It's not enforced. You are not enforced on me because there's no legal intention. But it's a contract, but it's not a serious contract. But some contracts must be signed in written form. We call it deed, executed in deed. Contracts related to properties, land, must be signed in deeds. Or any law, any contract, verbal contract relating to buying or selling a property or a piece of land will not be enforceable if it's not written. A will must be signed in written form. Okay. This verbal will is not a will. It's not enforceable at all. So certain contract must be signed in the written form called execute in deed. For a company to execute in deed, they normally have a seal. They execute under seal, meaning that you know what is a seal? Yeah, it's a company chalk, and then you put some red things on it, and then it carries your seal. And to exercise the contract in seal is meaning a serious contract binding the company. And the company must provide board resolutions to prove that. But for insurance contract, it has to be signed in written form to be enforceable. It cannot be verbal. It has to be executed in deed. It's not that serious to have to execute in deed, but it must be in a written form. Oh, okay. So there are verbal contracts are contracts. Some contracts that execute under seal. You know what a seal is. And insurance contract do not have to have evidence in writing in principle, but in practice, always in writing. Transfer of land and suretyship is guaranteed. Oh, okay. Well, guarantee contract must be contracted by deeds. These are serious. This is a deed. Execute and then put a stamp on it. Okay? Okay. So I don't think they will test you on this, but there's a basic principle of commercial knowledge that a contract has to pass ABCD 6 criteria. 6, right? Yes. Offer, acceptance, and now because you're Saudi, let me ask you: in an insurance contract, who is the offerer and who is the acceptor of the contract? The offerer is the owner, the policyholder, the acceptee. The acceptee is the insurance company. It's the insurance company. Okay. So, but when the insurance company say, okay, I cannot accept, according to your proposal, I will variate the terms, and impose some loadings on the premium. In that case, what happened? The premium will be higher. Yes, but in the law of contract, what happened? If one party does not accept, then there's no contract. Or they could, the offeror could give counter offer. Okay, when the insurance company make a counter offer, what happened? They negotiate
until the agreement is reached.
Okay, and in this situation, who is the offerer?
The insurance company is the offerer, and
Yes. So there is a reverse in the positions. When you are the policy holder, you make a proposal to the insurance company. I want to buy my life insurance. You make a proposal to AIA. So AIA will consider underwrites your risk. They say, no, I cannot accept your risk unless you pay me double the price. AIA making a counter offer to you. And that counter offer, in that case, AIA is offerer. You are the offeree. And you accept it, and then they become a binding contract. And all the endorsement, all these process will be documented in the contract, included as an appendix to the contract. Will be part of the contract.
So someone will take note.
It must be written. The counter offer will be in the letter form. You sign the letter, and that letter will be part of the contract.
Okay.
It will be in your contract book when you receive it.
It will be.
So there is a consideration. What is the consideration in an insurance contract?
You consider what risk you want to take, how much you want to put loadings in it. For example, like age.
Consideration is the premium.
It's the premium.
It's the money.
The premium amount.
It's the money. It's the consideration. These are terms. Under what clauses, of what terms I'm going to accept you. These are contract terms. Considerations, how much you're going to pay me and how much I'm willing to take the risk with what premium, what money I'm going to pay.
So it's the service or the items we exchange, so to say.
Our relationship, I'm the insurer, I'm AIA, you are the policyholder. Relationship is determined by the insurance contract, which is in the writing form. It's a booklet that is documenting all your health conditions, your declarations, your beneficiaries, everything in that contract, the insurance contract. The contract will only be valid if you make the premium. You submit the premium. The contract is not valid until it's not valid. It's not completed, enforceable until you pay the premium, and the reinsurance company accepts the premium. So it comes a time when we're dealing with a travel policy, travel accident policy, or a cargo policy. And in a life insurance, the insurance company must receive your premium before they can send you the contract. Will be valid, will be what we call it?
Enforceable?
Not enforceable. It's the contract is complete when you pay the premium. But in an accident policy, you don't have to pay. The insurance company does not need to receive the money before the contract is enforceable. It's like in a car insurance. If you want to buy your car insurance, you ask AIA to make a quote, and I made a quote. It's for your comprehensive policy. This costs you $5,000, and you accepted it, and you don't have to pay me. You ask me to issue a cover note.
The temporary coverage.
A temporary receipt or cover note. The cover note is a temporary contract. That means that from this point of time, you can, because it takes time to print the contract. So for convenience sake, for the legal compliance sake, the insurance company issue a cover note. A cover note is a temporary contract to give you the cover note, and then you can present it. When they have this insurance policy, you can issue the license to it.
I see.
So that, and in a cargo insurance, marine insurance, what we call, because the policy owner will change hands when you are the manufacturer. You deliver the goods to the pier with your bills of lading as the title document, and you transfer, you stamp it, you sign it. The title document now transferred to the carrier, which is the ship.
Okay.
And then now the goods belongs to the ship.
Yes.
It holds the title documents. So when you arrive, the buyer will present a document saying that this seller, I have completed payments, and I have received credits from the payers. I can present this bill of lading to the marine, and then the title will hand it over the title document. So policy owner will change hands from time to time with different parties during the shipment.
Okay.
It's called a bill of lading, and this is called a title bill of lading. And each party must have legal capacity contract. And as we said yesterday, some people are not set to have legal capacity contract. Who are they? Minors.
People under influence, and then insane people. Sometimes people with chronic illness is also considered not have the capacity to contract.
Corporations operating outside the normal course of business as written in M&A. The company, I'm a toy company. And I do not have any authority. The toy company does not have any authority to, let's say, to engage in property investment. So when I am signing a contract for investment, insurance company, and that is not, I have no capacity to sign. It's outside what we call it ultra-virus, beyond the authority of the company, determined by the setup of the company, documented in the M&A.
Okay.
And each side must have the intention to create legal relations. So this I've explained. Offer, counter offer. Premium, pay premium is a promise, and then the insurer promises to pay as certain circumstances arise. And then there is no, although this is a buyer, this is a seller, but under normal contract, a party can sue the other party for breach of contract or for consequences. If that, it's like for example, it's a rental contract. If I rent it for 2 years, and then I terminate it after 1 year, the landlord can sue me for the 1 year rental because for the cancellation and force the full contract. But in an insurance contract, it doesn't happen that way. The insurance company cannot enforce you to pay the unpaid premium.
Okay.
Okay, so it's one-sided contract. You pay, and if you don't pay, the policy lapses. No effect. Okay. Thank you, Tommy. Yes, welcome. We've started. Sit down and show your face. We are recording.
Yeah, all the hot water there's some gas leak in my hall, and then we had to first leave in the morning, and then there was no water.
Too bad. Face. Yeah, this is Soumya, and we are studying. We are on paper 1. So legality, a crime, smuggled goods are not insurable, that you know. So differentiate these terms: void, voidable, and unenforceable. Can you differentiate it? What is when a contract is void, what does it mean?
Like it's invalid. So like
it is invalid?
Yeah.
You treat it like it doesn't exist.
Does not exist. Yes.
Yeah, but like voidable is like supposedly either of the party makes like has like some negligence or like breaks one of the things of the contract, then the either party can decide if they want to continue or like they want to go.
And avoidable?
I think that's
what, yeah.
So it's not yet void, but it can be made void.
Void contract does not exist in law. The voidable contract is the one party can treat it as void, is by action of one party. Now, in Hong Kong, we have this case. It's a very common case. The Hong Kong government is suing a seller. The Hong Kong government is buying some face masks during last year. Because of critical situations, they purchased some from a trading company, 30 million of masks, face masks. And the trading company presented that these masks were manufactured in Japan. But when they received it, they found that no, it's not manufactured in Japan, it's manufactured in Hong Kong and in China. and they carried a box. The package is carried a Japan package. Under this situation, the government do not want this good, and want to, although they want to to get the money back, and they sue the trading company.
They can. It's fraudulent.
Yeah.
Is misrepresented, meaning that the terms of the contract is misrepresented by one party. So it is a void contract or is it a voidable contract?
Voidable.
Voidable, because they can choose not to do anything, like the company, but if they want, they can.
Mm-hmm. Yes, the government is considered this contract void. So they seek the Court of Hong Kong to return the goods and that got the money back. And then the Trade Department will pick this up and sue the company for fraudulent misrepresentation, or of the disruption. Under the Hong Kong law, they have the trade disruption law. You must describe your goods according to the original manufacturer. You cannot just
See what?
Yeah. So this is a voidable contract. For enforceable and unenforceable. And an unenforceable contract is not void.
But you can't make a legal claim of it. Like you asked me for lunch and then I said, no, it's unenforceable. You can't do anything about it.
You can sue me, can you?
No.
You cannot.
Cannot. You cannot
There
sue.
is no written contract.
There's no consideration, So the contract does not exist. You have two legal parties have legal intention to bind each other, and that is consideration. There's no consideration, right?
It's not like a legal thing.
Huh?
Like it can be like word of mouth, but not exactly legal. It's not set in.
A verbal contract is a contract. Yeah. If I promise to pay you, and for goods that I've received, that is is binding. It's binding on me. I must pay you. I cannot just ignore you. If let's say I buy you coffee, you said I will pay you, and you don't pay me. I can quote you. You owe me $25, for example, but it's not impossible. There's not so little amount involved. This could be very complicated, and when it is applied to the law of agency, and I think we need to explain a little bit. There are two types of agency insurance. Yes, who are they?
Agents and brokers.
Yeah. Agents and brokers, and they represent different parties. Agents represent the insurer, and brokers represent the proposer or the insured. And this or may or may not know. Under the laws of Hong Kong, insurance in Hong Kong, how many insurance company can they represent? They represent the insurer. How many insurers can they represent?
12.
Four. Which four?
2 of general and 2.
Two general and 2 life.
Oh, yeah. Long term.
Right. Long-term insurance. And in AIA, if you become an AIA agent, you can represent AIA International, which is the life insurance you can represent, and you must also represent AIA Company Limited, which is general insurance. And then you have 2 other choices to represent 2 other general insurance company. And AIA has endorsed for us to sign contracts with AIG, which is the AIA group of general insurance business, AIG, American International Group. And the other one is Zurich, Zurich Insurance. I represent 4 insurance companies. In the future, you can represent 4 insurance companies after you have passed paper 1, paper 3.
Can you represent, for example, like AIA and then the other one Prudential? So like between competitors?
You can, but in the agency contract that you would sign with AIA will forbid you to not allow you to sign to a competitor. And also, if you are an agent of Hong Kong and you cannot represent another insurer in China, so you cannot represent AIA Hong Kong and AIA Shenzhen. and not because of the law, it's because the agency contract is signed for bid certificate.
It applies to brokers too, or just agents?
Broker does not have that restriction. As long as they sign the contract with the insurer, they can represent different insurance companies. But again, a China in some a broker in some time can represent a insurance company in Hong Kong because of jurisdiction difference.
Okay.
But a broker in Hong Kong, like Hyundai, is a broker. He can represent as many insurance companies as they would like to choose. And it's a mutual business relationship. Did I explain the difference between a broker and insurance? I think I did.
You have to me and Alexandra.
Alexandra, can you tell the difference of broker and an agent? What are the differences other than just the representation?
Oh, no, like I don't know more than the representation.
You missed that session. A broker represents many companies. A broker will receive higher or lower commission. Let's say for the same product. What do you think? The broker's commission is higher or lower than the insurance agent?
Lower.
Higher.
Why lower? Why higher?
Lower because
let's say the commission rate is 50%. So will the broker get more than 50% or less than 50%?
They can get up to 90, I think.
They can get more. Why more?
Because they are making the deal happen. Like,
no.
Do they check the documents?
Because in insurance agents, you get renewal commissions, you get bonuses, you get incentive travel, you get a lot of other things on top of the commission. The broker does. So it does not compensate. The agent will receive training free from the insurer, but the broker will not receive free training from the insurance company. They have to train their own people. So they will pay high commission. Right? And so there is difference. Some people want to be broker, saying there are more flexibility, can represent more companies. Some say, no, I don't want, because I need the protection of the agents. The agents have offices. Brokers doesn't have offices provided by insurance companies. Okay. And this term, the vicarious liability. The principle of vicarious liability is incurred as a result of an act or omission of another. And just remember, vicarious liability is a omission of another. Someone supposed to do something, but they omit to do it, so then they incur the vicarious liability. All right?
It's like the sprinkler yesterday. Fire happened, there's no sprinkler, so they can't sue.
No, that is not a vicarious liability. Normally, this is the liability of the, well, what is it happened in a car accident in cargo marine insurance, and let's get to that. That is a very complex part. Marine insurance is very complex. We call it salvage, voyage, a lot of terms that it's difficult to explain.
Okay.
All right. So the agency relationship, and you come across this. An agency relationship can be determined by express term in a written contract or by the verbal contract. I delegate you to represent me in the contract negotiation. That is also good. It can be in implied terms. If I go to a department store and find a sales lady in uniform, and I am treating him as an agent of the department store, he cannot escape it because by the uniform he's putting on, he cannot escape the liability or that you're representing the department store. But if I ask a question about the department store, you shouldn't. You cannot say that I don't know. I can answer. This is implied terms of the agent. Or by rectification, doing something afterwards, retroactive authority. It can be done in writing, in verbal, or by conduct. And these 4 principles, and they will test you on of what authority of the agent has. Who has actual authority? I represent AIA. I am the authority I have is documented in the agency contract. Then I can accept a proposal. I can have my rights to my iPad, access full rights to AI internal information, full rights to the learning portal. So this is my agency rights. And I also have obligations too. The obligations including that if I receive I'm on a 3-year compensation term, but if I quit before the end of my terms, and I have to repay AIA for the training that I received. That is my term. And in the future, you will see the AIA contract. Apparent authority, that is apparent, not very obvious. It's like I go to a department store, is apparent authority because it's uniform. Go to a bank teller has uniform is apparent authority to take my money. Authority of necessity is out of necessity, meaning that can you make an example? Agency by necessity.
Like before surgery.
Like before they have the authority, like to give you authority, but it's the situation demands someone to take control. Like
maybe like before surgery, usually the doctor asks for the parents or for the spouse, do you consent for this person to be operated on, accept all the risks, and he might die, something might happen, and then the spouse or the parents have the authority to consent. Yes, I agree. You can operate on my son, on my husband, on my wife. Things like that.
No. That is not the authority of necessity. The necessity for an agent. We are talking about agency appointment.
Like when like supposedly the agent is in a deal, but you cannot reach your client, and the deal is ending in 5 minutes, and then you, because there was no other option but to accept or reject, you had to take authority in that moment and decide on behalf of your client.
Right. Out of necessity. In a situation that is necessary for someone to act on behalf of the principal, and he on behalf of the principal because of necessity that he will have the agency authority to represent the principal. That is a situation like when I am let's say I'm an employee of a company. And today I just resigned. I'm no longer an employee of the company. But there's a fire. Then I acted on behalf of the principal, tried to protect the property. And then because of that, I am acting out of necessity to be an agent of my company. And I'm still protected by the employees or by the employee compensation because of this agency principle out of necessity. In that kind of situation, you cannot escape. And this agency by estoppel, meaning that you cannot deny that you are still an agent of the person. It happens when they, for some of the, when you always see some newspaper, something to declare that these employees left my company and they're no longer with my company. So whatever he does, I'm no longer responsible. And this advertisement is needed because of this principle. If no one knows it's been out of agency agreement, I still believe you're an agent of that person. I still do business with you, and he cannot deny that you are not an agent of the principal. That is agent by estoppel. Very important for you to declare this person is no longer my partner, my agent. Estoppel. All right.
Is that yours?
I think yes. Yeah, that's mine.
Now, the agent is allowed to appear to have the greater authority and actually confer the agent's relationship was ratified. He is not authorized, but he is allowed to appear as if he is the agent of the person by ratification.
So isn't estoppel means he can deny?
He cannot deny. He cannot deny he is an agent. The relationship, the agent's relationship is operating under this principle, agency by estoppel. You cannot deny that you're not an agent. So I still treat you an agent. And your agent authority is ratified afterwards.
Okay.
So these are the 4 situations. So agent, we have duties, and each side have a duty. The principal and the agent have both this responsibilities and duties and obligations. And then termination. Termination can be by mutual agreement, by revocation, by breach, by death, by insane, legality, time, the termination.
Okay.
Let's deal with the questions later. So if you are an AIA agent, how can you terminate your relationship?
You resign?
You can resign, or the insurance company can terminate you, give you notice because you do not fulfill the quota. Or also, if you are violating some of the internal guidelines, and they will penalize you, we have a marking system. If you have misconduct, let's say you create your own sales material, you present the company as some products, and customer complaint, and after internal investigation saying you're wrong, you are misrepresenting AIA, so I give you a penalty. Penalty can be suspending the license or terminate you for a period of time. Even if the minor thing is to give you a penalty, 4 points. It means a marking on your agency. If you get 10 points over a 2-year period, then you are terminated.
Okay.
Because misconduct, I think, is a really is a compliant issue. So we have studied the law of contract, the law of agency, and now we are on this principle of insurance. And there are only 6 principles. So can you tell me what they are? Insurable interest?
Can you? It's like wife, minors, or child from previous marriage, people you can insure.
No, it's like if you're signing a contract, then you need to have something that you're signing it on, like something that you can insure.
So like body parts.
The thing that you're insuring, you need to show that somehow you have interest.
Does anyone have a pen?
Or that somehow you have interest in that thing.
Okay.
There are many parties to interest contract. The insurer, proposer, who also become the owner, and this the insured, and this is the beneficiary. And we talk about this relationship, right?
Yeah.
When a proposer makes a proposal, the insurance company accepts it, underwrites it, accepts it, and pay the premium. It becomes a contract. And the contract, a party is named. They call the insurance target. It could be a property, it could be a person, it could be part of the body, it could be your arm, leg, your voice. The insurance can be a property, or can be a person, or can be something.
Okay.
I insured my antique. So, and this insurance contract will work if I pay you the money and you give me the protection. I promise to pay if these damages happen to this insured, right? And I have the responsibility of keeping this insured proper. I cannot kill them, I cannot destroy them, and then claim you. This will be moral standards that I keep my moral standards on the insured person. And for this contract to be valid, there is something called insurable interest. That means
this person should have interest in this.
And I must have an insurable interest. I own this property. I own it. And I have an insurable interest. Insurable interest on my mind. So there's a legal definition of who has insurable interest. What are the
Um,
insurable interests?
Blood relation, property ownership,
Legal relationship like husband, wife,
yeah,
Immediate family relation, immediate member,
immediate marriage.
and husband and wife, father and son. Okay.
Niece and uncle.
No.
Oh, niece and uncle.
No.
grandfather, grandson.
Grandfather, no. You cannot insure your father.
No, grandson and grandfather.
You can insure your grandson.
Yeah, you can.
You can.
Stepson.
Stepson is
yeah.
legal.
Yeah, legal.
Legal son. But can you insure your father?
If you are above 18, you can.
Can I insure my father?
I hope so.
Yeah, I hope so. If he's still, in legal.
Unfortunately not. I don't think so. You cannot name your father as insured. You pay the premium and then you kill your father. You benefit from the death of the father, you won't benefit from it.
So
Legally you have no loss. Probably you have gains. If your
But
father
that's
dies,
the same thing with your son, right?
yeah, you gain nothing if your son dies.
well, I have lost because my son will repay me when I'm old. So I have insurable interest. I have to pay him, feed him, educate him. I have some invested a lot of money into my son. So I have insurable interest over my son, but not my father,
Then
not my parents.
can I insure my brother, for example?
No, you can't.
I can't.
You can't. Only immediate family members, father and son, husband and wife.
Okay.
And grandson, grandfather.
But not father and mother.
Not father, not mother, not father-in-law, mother-in-law. No. There's no legal. All right. I can insure my property. If I house, I can insure my house. If I have guitar, I can insure my guitar.
You can.
Well, if it's a very expensive guitar.
If it's an expense.
So this is insurable interest. And also, if I'm employer, this is employee. Can I insure my employee?
Yes.
Isn't that employee compensation?
Pardon?
Isn't that employee compensation?
Employee compensation is a legal thing. It's a corporate conduct that is required by the government. It has nothing to do with employee. It's not involved in employee's life or accident or something. But as an employer, can I insure my employee? If my employee suffers, dies, then I get paid?
No, because then you're going to kill him, right?
You can, because they're asset to your company. I think. And
So will I have, if I'm the employer, the company limited, will have the insurable interest over the employees?
Yeah, because you would give like training and you would invest in their learning.
Yes, of course.
And they represent your company.
Do I have an insurance interest over my business partner?
No, you said no, right? Yesterday. Like if it's legal.
Legal business partner.
Yeah.
So I name my partner 1, partner 2, in a chain.
Accountant.
In a chain, contract.
Oh.
I insure my partner insure me.
Oh.
So if I die, any one of us die, the other party will get paid.
Oh.
The money will pay to the company to buy my shares. And that's called human insurance. So partnership insurance. Directors also. A company can insure its director. Because the directors are important assets of the company. If the director dies, my company suffers.
Okay.
So I can pay. The company can pay for the insurance premium for naming the directors as insured. But under this normal situation, will AIA accept money from other parties? Like, for example, I, the individuals, insured my son with AIA. Who has to pay?
You.
Can I pay by my company?
If you die and you.
No. If for my insurance over my son, can I pay the premium by my company? Check. By company check. Will I accept an insurance payment by other parties other than these insured
No.
parties?
No.
He can get the money from anywhere else, but he has to do
Can my
something.
wife pay? I'm the owner. Wife is not is not named, not even a beneficiary. Can my wife pay my son's
No.
premium?
No.
I don't think so.
I don't think so too.
Yes, because my wife and I has insurable interest. Yeah, not my father,
Okay.
but not my company. My company does not have the insurable interest over my son, so the AIA will not receive any check from my company, limited company check. The only thing that I can accept the company check is for me to prove to AIA that I'm a shareholder of the company. I own 60%. And the company pays for my premium. And I'm the insured person. Only that. It becomes technically complicated. I have to prove that there is a company ownership in the business.
Okay.
All right. So other than this is called beneficiary. We talked about second policyholder and second beneficiary yesterday.
Mm-hmm.
Now, this contract now worth 1 million US.
Yeah.
Can I sell it to you?
No.
That is a cash value, right?
That is cash value. Can I sell it to you for $900,000?
I think no.
Then you can take my money back if I die. I will die
You
someday in the future. Then we take my policy as a security
can.
and give you money. Can I mortgage, pledge my policy, life policy, to a creditor?
Yeah.
You can. You can.
This are called reversed what? Reverse insurance, reverse contract, something like this. And these can be a bank, can be the mortgage corporation in Hong Kong.
Mm.
And if I own the policy, I pledge it to the company, and this company give me some money, an annuity, pay me until the day I die. If I die, the insurance company will pay this $1 million and the pay.
The annuity is paid to you or to
Paid
the
to me.
mortgage? Oh.
The mortgage company, mortgage corp, take my insurance contract as security. I sign a pledge mortgage agreement with them. Give me an annuity. Pay from my 66 to my today I die. Pay me $10,000. So this is arranged. Can I assign my policy to my creditor? Like I owe someone some money.
Mm-hmm.
I owe the bank, my credit card. I run out my credit limits. I pledge my card, my policy to the creditor. Can I do this and get money advances?
Can.
You can pledge it. I'm not sure if you can get money.
Can I pledge it? Do you think you can?
I think you can.
Because this is my asset.
Yeah.
This is a asset of the policy owner. It has cash value. It is cash. I can pledge it to the insurance company and get a loan, policy loan from the insurance company. But right now, if I borrow it from the insurance company, I get 6.5% interest. And I can only borrow up to 90% of the cash value. And there is a high interest. But I can also pledge it to the creditor. And then these will become to do these, I must write to the insurance company saying that I have assigned my policy to my creditor and I need to have a consent of the I can do this. So there are many parties involved in insurance. And in any event, the insurable interest, then after I pledged, then this creditor has insurable interest over the policy.
Yeah, because then their payback depends on if you are paying the premium.
Yes. And then utmost good faith. Can anyone explain what utmost good faith is?
It's just that the information you give should be true, and even if some information is not asked, then you think it's valid or important.
What information?
Like if it's a life insurance and about your health, if it's about the property, then maybe like about the land of the property, there were any issues like construction.
The generic term is anything that is related to whether I should take a risk.
Yeah.
It's called the material facts. It's not the trivial facts.
Yeah.
It's how many fingers you have, those things like that. Do you paint your fingers? That's not material. Material facts is that for me to accept or reject your application and how much premium I'm going to charge. These are related to material facts, and that has to be utmost.
Okay.
Utmost good faith means there's no lie, there's no hidden. It's disclosed. Utmost.
Yeah.
If I forget, I forgot that I was admitted to hospital 7 years ago, and I did not disclose it in the contract. What happened?
Contract is voidable.
Like I think there's a limitation on how like past you have to go, but like if it's like more recent or something, like if you went in for like a major surgery 7 years ago and you still have like things that come up, like you need to go for physiotherapy for that surgery, because supposing someone's taking a life insurance at 50 and they don't remember if they had surgery at 20 or something, so then they can't be held accountable, right? Like after that point of time, I'm not sure.
I think the contract is voidable because they violate the utmost control.
Yes, but it just happens. I just forgot too long ago.
Then I think they're different, right? Like, because then it's voidable because then the insurer, the company can decide if it was fraudulent or like misinterpretation or it was like actual mistake. I think they kind of look into that matter and then decide.
I think it's innocent negligence. So it's not malicious in nature, but it just happens. So yes, there's consequence, but
it all depends whether this missing information is material.
Yeah.
If it's material, because of this non-disclosure, it will affect whether I should accept your policy
or not.
Not, then it's voidable because you have violated this principle of utmost good faith. Right? And this principle of utmost good faith applies to all the parties in the contract. It applies to the policyholder. It applies to me as the agent facilitating this contract. If I know something that these policyholder is basically one-eyed blind, then I do not disclose. I hide that information just because I want to get my commission. I violate the utmost good faith, and the contract is void.
Okay.
Okay, so it applies to insurance company. This company disclose, hide some information about the contract and not disclose it, then it's also voidable.
Okay.
All right. And in this case, if a client really forgot about his being admitted to the hospital, and when he make the claims, let's say a death claim or hospital claim, the insurance company normally will write to all the doctors in Hong Kong. It's asking this person now saying that he has been admitted for this disease. Do you have any knowledge that is a client of yours? When did he last saw you? When did you know that you have this knowledge of this disease? Whether he is materially, fraudulently,
not told.
Non-disclosed. And if it's a fraudulent transaction, then no matter how many years of payments are made, it is still voidable.
Will the premium be returned?
The premium will be returned. There's no contract. The return will be returned to the proposers, and I will refuse the claim. But sometimes the insurance company will check. Okay, this is a minor thing. It is another fact. It's not a material fact to the contract, so I still admit, still pay.
Oh, okay.
Still pay. Because it's non-material. And in the policy, there is a clause called the incontestability. What is incontestability clause?
You can't contest if it's not a material fact. You can't contest the claim.
Normally 2 years.
After it is in effect.
After it's in force of 2 years. And if I do not decline, and after 2 years I cannot decline, even though you forgot about your hospital thing years ago, it still be valid after 2 years. So this protects the consumers for non-fraudulent misrepresentation. If it is fraudulent,
Then
this is doesn't apply. Proximate cause, and this is very important. I think they must have 1 or 2 questions about the proximate cause. What is proximate cause?
Reason that ultimately caused the perils, but not the only one.
Now, there are many reasons, and the proximate cause is an example, is lighting, buttoning. There's a lot of perils happens to your house, but whatever the primary cause, the proximate cause is fire, then whatever is flooding your house is still under taking some claim under the fire policy. That's proximate cause. And indemnity. What is the indemnity? Principle of indemnity.
It's the exact value that needs to get paid back. The amount that
It's a compensation.
but exact amount.
Yeah. In general insurance, we call it indemnity. I insured my property, my computer is damaged, and I'm going to claim for the indemnity, meaning the repairment cost or maximum is the replacement cost of my computer, similar computer indemnity. But in life, there's no indemnity because life is priceless. It's not indemnity, it's a compensation.
Even in personal insurance, like accident, there's no indemnity, right?
Yeah, they call financial compensation. It's a compensation. Contribution, I think you will, is something that I share the cost, share the risks. I think, okay, this insurance of liabilities, primary liability and vicarious liability. We come to this term again.
Vicarious liability is because omission of
acts. Someone is acts. Okay, we call this already assigner, assignee. You can assign the policy. And assignment by writing. Notes quickly explain this. Duty of disclosure. Both parties, insurers and the proposer, both sides of disclosure, liability, common laws, policy term, material changes of risk. If I buy accident, if I buy property insurance, but there is any change in the material conditions, risk factors, I must report to the insurance company. Otherwise, the contract is void.
Can material change apply to a person, or is it just property?
Both terms.
For the person, what kind of material change could happen giving birth? Or
material change. Let's see. Not happen to a life insurance because your life has changed in any days. It probably applies to the general insurance more. Because in a life insurance, it doesn't matter whether your health gets worse or not, because it will protect you according to time and then your health, your confidence, I mean, your life conditions. But if you ask to increase your protection amount or your policy lapse and you ask
then
to
reinstate it, renew and see everything again.
And for new ones, for increase in amount, change of policies, like I'm trying to convert my term policy into life policy at that time, you have to reassess your health conditions. Material change to be insured. Fraudulent, non-fraudulent, fraudulent, non-social, we explain this. Okay. Let's see if I have some financial compensation. We mentioned about that. And we call it policy, benefit policy. This is called indemnity policy. This term will come to you. So in life insurance, there's no indemnity.
Because it's called compensation.
It's called compensation. It's called benefit policy. But for general insurance, there are four ways of indemnity. Reinstatement, like a fire policy, reinstate the property. You repair it, you give you cash payment, or you give it a replacement. So four are valid way of indemnity for property insurance.
Okay.
Car insurance, if you broke your car, then you can replace with a similar brand, similar model, similar age, or pay you the cash to buy another car at that depreciated value. Current value.
For reinstatement, does that mean that, for example, your house burned down and then you are given another new house?
No, just
remake that.
Refurbish.
Yeah.
Refurbish it. It's not including fixture and decorations, just the structure.
Okay.
And salvage is the something left, the values.
This is like depreciation, right? Like salvage value.
And this we happen to want to have one or two questions on this questions, and you need to learn this term. Salvage is the remaining value. The remaining value of the property is called salvage. And then abandonment is surrender of the ship, surrender of the goods, throw the goods into the sea, something like this. And the insurer may benefit from its residual values.
You abandon the item and there will be residual value? Like you throw the goods into the sea?
Yeah, but I might have residual values from other goods that I did not throw into the sea. So you must know this term, franchise and average. Know this term? And the risk is shared between the two parties, the insurance burden and the insurance burden. And you will come across questions like what is the total loss shared between two insurers and the salvage value, and how much will they get? And this term, franchise, is once you reach certain points, you pay the whole amount or percentage. But if you not reach that amount, there's no indemnity. Okay, all yours, all the insured burden.
That's policy.
If they do not reach this amount.
This amount is called policy
franchise. Yes. It happened in marine insurance. If you not lost more than $100,000, all the risk is lost.
But the coverage is just above the policy franchise, right?
It could be 100% or could be a certain percentage. And total loss, there's a policy limit, and there is a surrogation. This is a substitute. Two things happened. Corollaries, the indemnity is a contribute to the indemnity, or you surrogate the indemnity. Contribute is to contribute part of the loss. And let's say if a property is insured by two companies, then the two companies share. Like a medical policy, if you have two medical policy and now the claim is $100,000, and the first policy will claim $50,000, and the remaining up to the total loss amount. There is a situation.
But you can't get more than 100,000.
Yes.
Like you can't get 100,000 from home.
Yes. And there's a situation where you have overinsured and underinsured. Let's say your car is only worth 100,000, you insured for $300,000. What happened? You're overinsured. Will the insurance company pay you more?
No, you will still get the value.
The current value. That's what value. And if you are underinsured, let's say your car worth $100,000, you only insured for $50,000. What happened?
You only get 50,000.
50% of it.
So you
of the
only get
indemnity.
25,000? Or
100,000 value, you only insure 50%.
Yeah.
When you incurred a loss, the insurance company only pay the loss, 50% of the loss. Because you're underinsured.
So if your car is 100,000, you insured 50,000, you lost all of it, you only received
No. Now you insure amount is 50,000, your car's worth. This is insured amount. Now there's a claim for $60,000 loss, and the company will only pay 30,000 because you are underinsured. You are not protected the full amount. So when you make the claim, you will not get the full amount. Otherwise, you will benefit from it because you incur 50 and then the loss is 60. If I pay you 60, then you get benefits from it. So indemnity meaning no benefits at all. So you in this underinsured, you get a proportionate to your. So this question will always ask you. Easy to get.
Okay. If you lost 100,000, will you get 50,000?
Yeah.
Oh.
No.
No.
No, if the loss worth is 100,000.
If the loss is 100,000,
yeah,
you will get 50,000.
You will get 50,000. Yes. No. Wait a minute. That's 100,000. Yeah. Because you buy half. Now, if there's a share, let's say the car is worth 100,000, you buy two insurance company A and B, and you insure 50,000 here and 50,000 there, 30,000 there. What happens if you incur this 60,000?
They will split between this one will got bigger, and
this one will pay 80%. Eighth by proportion. By proportion.
Okay.
You get this shared proportion.
Is this fixed amount 6? Well, 5 per 8.
Yeah, by the proportion. 150, 130, so the total is 80, and you get 50 of 80 of the loss. The loss proportionate to the insured amount. So easy job. And surrogation when there's a third party involved. Now you buy the car insurance and your car is hit by a third party, is all third party's liability, and you claim your insurance policy. The insurance company paid you according to this rule, and then the insurance company, because the fault is by this third party, I can take over your place, and the claim procedural gains will be passed to insurer. If I receive any reimbursement from this company, and then the reimbursement will be for the benefits of the insurance. If there is excess, the excess will be.
In this case, first you have to pay you have to first pay him before you can do subrogation. Like first you need to finish your duty.
I pay first, and then I take under the law. I have this surrogation.
Like you can.
Rights. Yeah.
If there is excess, the excess money goes to the insured.
It is a not thing.
You can only subrogate the amount that you have paid, right? In indemnity.
Where's it? On.
So you can't you can't sue the third party for excess money?
No, I don't think so, because you have only paid that much, right?
Stop.
Because there was question in the mock exam about if you lost a ring worth 50,000 and then you make a claim, the insurance company compensate you 50,000, but then you found the ring, you sell it for 60,000.
Who gets what?
Who gets the 10,000?
Who sold the ring?
I think you solved the ring. Once you found the ring, will the insurance company get the 10,000?
That's not allowed, right? Then you have to tell the insurance company that you found the ring.
The question doesn't tell more than that.
I think we will come to that. How surrogation rights arise is rights by tort in contract under statute in Savage. Third party. Okay. How applicable? Repair. Other considerations: indemnity for 100,000 and 20,000 for the insured, 100,000 to the insurer. The insured gets the salvage value. This is insured for 100,000. The total loss, it is indemnity for 100,000. Then right now it is sold ultimately. Then the insurance gets 100,000 back, and the remaining money will go to the insurer, to the insured, because it's a salvage value of the insured.
So in the ring case, the 10,000 goes to the insured.
Insured, because it's paid.
The insurer doesn't get anything.
Insurer would get
The
50,000.
Okay.
And make sure you understand this part. What is saying this policy limit, the insured will bear the losses up to this policy limit, and then the insurer will only burden is for up to this limit. Up to this limit. There's over this medical policy. If you're insured for 50,000 for the operation, the maximum that are paid is 50,000, and then any excess of 50,000 will be the insured's burden. Policy base amount insured, and this one is the same. Average is the same. And the policy excess or deductible is the reverse. Anything under the deductible limit will be for the insured.
So it's like the tax deductible?
Not taxable. For example, medical policy. The first 20,000 will be for the risk for the insurance will pay the first $20,000. Any excess of 20,000 will be claimed against the insurer.
Like maybe the maximum value of the policy.
This is called deductible policy. All right, this is where it's okay. This part, I think you have to, then you read it from the syllabus. It will have questions on this. What is the pay-up capital for insurance company, and then what license do they give? This you just study it and remember it, short-term memory. Okay, can help you. And what is meant by fit and proper? Who can be a insurance CEO? Can be an agent. An agent has to be a proper and fit person. And what is mean by FRFP is bankruptcy, something financial status, solvency is part of the consideration. And then we talk about this in reinsurance. Reinsurance.
Not yet.
Adequate reinsurance meaning
like the insurance company has an insurer.
Share the risk to another insurance company or reinsurance, and the reinsurance company must have adequate reinsurance.
The one we talked about that.
Must have part of the. It's not taking the 100% of the risk, but share some 60% go out to another. Only take 40% of the risk, and you also share the premium 30%.
Okay.
And for this reinsurance business, they don't normally do direct business with the client. Just this client is the insurance company. So it's very specialized type of insurance company.
Is there any company like that in Hong Kong?
Yes, but this normally international companies, Swiss reinsurance, Zurich insurance. There's international because you not Hong Kong market is too small. So read this part. I won't go over it. And you are student. Now this conduct of the insurer and conduct of the insurance agents to read the guidelines. Because I think there must be questions coming out from the guidelines. Okay, let's do some exercise together. Just sign in the agency code.
I think you need to switch the share screen.
This is the way I go into the iAcademy.
I mean, you need to switch the shared screen so this will show instead of
I'm sharing.
previous one.
I'm sharing the screen. Okay. Let's
No, you're still sharing the previous one.
okay. Paper 1. 10.
11.
We just take some of it, okay?
Okay.
So we need to go to you know how to trick this machine?
You just submit the work.
Submit. 75 questions. All right. The insurer mentioned in the word risk, it means what?
Property that has insurable interest.
This one. Property risk that the company insuring required to be insured. Then show 3 threats posed by the risk may be financial risk. Yeah. Results in financial, physical, and emotional risk.
Isn't emotional not counted?
No, it's the same threat by risk. It's not saying what is covered.
So pay attention to the question. This is tricky. The threat is emotional, but the insurance only deals with financial losses.
Okay.
So just don't.
Non-physical. Financial and physical.
Oh.
Okay, don't just look at the answer and then. Which of the following statements that describe risk management is true? It's one of the methods. So it's easy. Let's skip. Let's go to the more difficult ones. No, this is complex. Which 3 of the following describe the simple contract formed by individual conducts are incorrect? Pay attention to this word, incorrect. We're talking about incorrect. So you make assessment if such transaction is not a contract in law. Is that incorrect? Now, read again. Which 3 of the descriptions in the simple contract formed by individual? What is a simple contract? Simple contract can be in word, can be verbal, right? But the basic requirement is
it's not inside.
Oh, it can be.
It can be.
It doesn't have to
the
be.
Principle is a 6 principle: legal capacity,
Enough person or insane.
Right, consideration. Such contract is not a contract in law.
No, that's wrong.
It's not.
It's not legal.
It's not legal. Yes, there.
So this has to be included. Oh, sorry.
Number 2 is number 2. This is a special case, and that's called special contract. No, not correct.
So 1, 2.
In order to valid the contract, this kind of contract was submitted subsequently in writing. No. So 1, 2, 3. So to check whether 4 is not.
No, It
What
can
is fault?
be, even if it's not expressed verbally or in writing.
Even it is not expressed.
Yeah, even if it's not expressed verbally.
This is
it's
true.
correct. This is true, yes. Okay, let's try some difficult ones. A contract inferred from conduct is a simple contract. Ah, so easy.
That's the answer for the previous one.
Okay, if it is not possible to sue a non-void contract, this contract can be called unenforceable.
That should be
Because it's not legal.
It's not possible to sue, it's unenforceable.
Because it's not legal.
It is legal, but it's unenforceable.
Because you can't sue something that is not there.
Yeah. It is not possible to sue because it's signed outside the jurisdiction of Hong Kong. It's not government the jurisdiction of Hong Kong. You cannot sue in the Hong Kong court. But it is called an unenforceable contract. But it's a legal contract. Right? Many contracts are signed outside Hong Kong for tax reasons, Not enforceable in Hong Kong. It's under the law of Bermuda. It's enforceable in Hong Kong. And we did it on purpose. We did it on purpose. Just to avoid tax. Let's try some different ones. Go back to the couple questions. Okay, this 1, 2, 3, 4. Now, wait, pay attention. Which of the following are characteristics of life insurance? 1, insured person usually has the end of period benefit. Yes. It is a long-term business. Yes. Insurer cannot cancel life insurance policy. And insurer cannot cancel a life policy. Yes. I cannot cancel. Only you can cancel. If you pay the premium, I cannot cancel.
Yeah.
The agent cannot cancel the contract.
The insurer, the insurance company cannot cancel a contract.
Insured can cancel.
Yeah, the policyholder can cancel the policy just by stop payment or by writing to the insurance company, I want to stop it. This happens to, for example, travel insurance. Normally it's continued, renewable every year. If you renew to pay the premium, the insurance company will continue to protect you. Each year will just issue a renewed letter. Your contract is renewed. The contract is unchanged. But if I want to stop it, I need to write to the insurance company. Otherwise, the insurance company will debit my account. Okay, 4, the insurable interest is only needed at policy inception. That is true.
Yeah.
Insurable interest only at the point of inception. And after that, doesn't matter.
That's only apply for life insurance or also for other general insurance personal?
I think life insurance, right? Different insurances have different, like before or like at the time of claim, like when it starts.
We talk about life insurance. Life insurance.
Okay.
So you can change your beneficiary anytime after inception.
Okay.
If there's no insurance, which of the following handling methods are correct? Paid premium refund. Easy. So you should be able to answer all of them. Let's deal with some complex. Okay, this one. Okay. The builder paid $13 million to a car owner in an accident. Because of the application of each liability action limit, the car driver only received a claim amount of $12 million from the liability insurance. If the insurance later recovers $7 million from a third party, who is entitled to the money?
The car driver only received 1 million. Insured take 1 million because
the insured takes 1
cap.
million. Yeah. And insurance takes 6 million. Insurance takes 6 million because it's paid 6 million dollars. The insured debt person take the remaining 1 million.
Just like that example.
Like the ring.
And these one are easy. Oh, these are really. The marketing department continuously monitored at one's present and potential market. The process called easy chapter. So you must get this part right. The function of accounting investment excludes
What's premium?
premium rating.
Oh, that's
This is
for
actually
the
actuary function. Just easy answer, easy chapter. Okay, complex. 1, 2, 3. What are the functions of insurance agents registration board? This has been changed, right? You should be aware that now insurance agents and broker licensing are now under the insurance authority, no longer with the insurance agents. So this has a complete change. You have to get updated.
Okay.
All right. So read the guidelines. And insurers will classify the source of business into 3 categories. From referral by existing customers.
That's a bonus.
That's a bonus, right? That's a bonus. All right, just should stop here. You should be able to. Let's change to paper 3.
Can I get water? Yeah.
You want some coffee? Get some coffee.
Yeah, you
need coffee?
Yeah.
You need coffee?
Had a very rough morning.
So you take a bath without water, or
You have to take a bath with cold water.
You give them the coupon. I have only 2 left.
What do you want?
I don't.
thank you. Do you want extra water or?
Yes, please.
Thank you.